Welcome back to our intermediate financial accounting class. In our last segment, we were talking about property, plant, and equipment, PP&E. We talked about why it's so important, and then we talked about what kind of costs get capitalized into our PP&E accounts, and we mentioned how important this idea of capitalizing is. And remember, it's the process of putting a cost into the asset account, debit to property, plant, and equipment or land or building or whatever, and crediting cash or notes payable or whatever we're on the hook for to build this asset, instead of expensing it. So instead of having credit to cash and a debit to repairs expense or to construction expense, we put that into an asset account. It becomes part of our PP&E, shows up on our balance sheet, and then gets depreciated over time. Now, we then talked a little bit about how different costs get capitalized, and we talked about a specific rule of thumb, and that is whatever we spend getting that asset ready for us to use gets capitalized. What we didn't really have time to get into was what happens if we build the asset ourselves or we pay somebody else to build a specific asset for us. So we're not talking here about going to the line and waiting while that piece of equipment goes through their construction process and then we take it. We're talking about a specific piece of equipment or a building that we had to make for us or that our employees go out and build. Those are called self-constructed assets, and they're a little different than what we do with other kinds of assets. The basics are about the same. We're still capitalizing those costs that we have to spend to get this asset ready for us to use. So design fees are now included because we have to hire an architect or a designer to get this ready to go. We have to get special permits if there's inspection fees, etc. Those become part of our self-constructed asset. We keep track of our direct material and direct labor. These are the actual raw materials that we put into the job, our wages for those who actually work on our project instead of the other projects we may be working on. And then we have to do something with overhead. And FASB gives us two options with overhead. You probably remember that overhead are all these other production costs that aren't part of our normal, easily traceable materials and labor. So the plant supervisor's salary, security on the plant, insurance on the plant, maintenance for the plant, utilities for the plant. I can't trace those to specific jobs, so I call them overhead and I allocate them based on some measure that I've decided on that allows me to put it into different places. Well, FASB said, great, you can do that. You can use a logical measure and just allocate the overhead into your specific project and capitalize the piece while you're allocating to all your other jobs. Or, we don't like this idea, but we'll give you this option. You can also just not allocate it to PP&E and just allocate it to your jobs you're doing for your clients. Most companies choose to capitalize. We like to capitalize costs because instead of showing an expense right now, we get to put it into assets. It beefs up some of our ratios and also allows us to take the expense over time as we depreciate that asset. So we prefer, if we can, to capitalize it. At least most companies do. Now, it's even easier if I hire somebody else to do the project for me. So they're still building it to my specifications. Let's say I need a specific building. I can't just use one that's out there because I have specific showroom requirements for my clients as they come in. I have specific collaboration teams that I have to have space for, etc. So I hire a company to come in and build this for me. Then it's really easy to track these costs because I simply keep track of the checks I write to the company doing the construction on my self-constructed asset. Same thing, if I build that special building myself, I can also track those costs, but it's much easier if I'm just writing checks and keeping track of those costs. Now, the other major cost that we have to deal with, both for self-constructed assets and for other assets we buy, is our interest costs. You see, most of the time, we need a significant amount of capital for new property, plant, and equipment. That's one of the reasons we call it capitalizing, is it's because we're taking capital, cash from owners and from debt holders, etc., and turning it into an asset, a long-term asset, hence the name. Well, because we need so much cash to buy these assets, more often than not, there's some interest involved that I'm accruing, not because of normal day-to-day operations, but because I bought this new asset. And companies went to FASB and they said, hey, because we're only getting this interest because we did the asset, built this asset, can't we capitalize that interest? And FASB said, no, well, maybe, well, sometimes, was their final answer. And so they put down some requirements that we have to know in order to decide what interest we can capitalize. And the first one is it a self-made asset? If it's not, you can't capitalize anything. So if I go down to the store and I buy a new piece of equipment, let's say I buy a truck from one of my suppliers, and I take out a loan on that truck so that I can buy it, I get that interest expense that I'm paying, and tough. It doesn't get capitalized, it becomes part of interest expense. If it's a self-made asset, then if I meet a couple of other conditions, I can capitalize at least some of it. But that's our very first requirement, is that it has to be a self-made asset. Self-made, again, meaning either I build it or somebody builds it to my specifications, not that I have to go out and do it with my own two hands. The next requirement is that we can only capitalize during the capitalization period. And basically, FASB defined the capitalization period as the period from when we start construction and start paying for it. We have to do both until the asset is substantially ready to use. I could move in and start using it if I had to. During that period, I can capitalize interest. Before and after, you just have to expense your interest. But during that period, I can capitalize it. So if I hire, let's say, your company to come build this special office building for me, and I pay you a check up front, $100,000, and you start construction a month later, and 2 months later you've got the job done for me, then my capitalization period is 2 months. 3 months total of our contract time, but because you waited a month to start building that asset, that only leaves me 2 months that I can capitalize. Same is also true if you come in and get started and build for a month before I cut you a check or before I pay my employees, right? If monthly payroll, I just miss monthly payroll and I don't pay them for a month, well, until I pay for those raw materials or that wage expense, again, I can't capitalize. So I'd still only have 2 months I could capitalize. So we're feeling pretty good about this now because we've met FASB's requirements. We're in the construction period. We've made payments, so we're in that capitalization period. We have a qualifying asset because we're building it or it's being built for us. And then FASB threw one last requirement on us. They said you could only capitalize the lesser of actual interest accrued or avoidable interest. And we said, well, okay, we get the whole actual interest accrued thing. I know that. I can see the interest rates on my debt, and I can calculate what accrued during the period. And I can add that up for all my different debts and get total interest accrued. But what do you mean avoidable interest? And FASB said, oh, avoidable interest is the interest you could have avoided if instead of making this asset, you had paid the bank back. Okay, that kind of makes sense. At least the concept does, right? Avoidable interest is the interest we could have avoided. It's another one of those clever accounting terms. So what if we pay back the bank instead of paying the construction company or our own workers? What could we have avoided in interest? So let's take a look at how this process works and how we calculate this value. Here's FASB's logic for avoidable interest. The best way to illustrate this is with a timeline. Let's say that we're building this building. I've hired your company to build this building for us. So on January 1st, I go to my bank and I take out a loan for the $500,000 that I'm going to have to pay you for this construction. So it's a 10% interest rate, $500,000 loan. You're happy to do it now that we've got money. But you and I get into some arguments, and there's an architect that's being kind of slow, so it takes us a while to actually get stuff started. So by this time, you actually start shoveling dirt to create the foundation to build my building. Let's say it's September. By then, this is where you actually start construction. And I send you a check. Well, interest is accrued all of this time since I took out the loan. All of this period has interest in it. But if instead of paying you this $500,000 to build my building, if I'd gone back to the bank and said, hey, take your money back, we're not going to do it, I could have avoided paying interest on this period of the year because I would have paid the bank back and they couldn't have charged me any interest. So the concept here, the calculation would be, let's see, $500,000 loan times 10% interest rate means that over the course of the year I'm going to accrue $50,000. But if I'd paid the bank back at the end of September, October, November, December, I would have missed 3 months worth of interest. So I could have saved $12,500. This is avoidable interest. That's what we're doing with this concept. Now there's a few steps to it, but this was FASB's logic. And again, we're just pretending. I really did pay you $500,000 to build a building for me. And you built it, but I can only capitalize the smaller of the $50,000 that I really accrued over this year from the bank, or the $12,500 that I could have avoided if I had told you, you know what, forget it. You've waited 9 months, I'm not interested anymore, I'm just going to pay the bank back and save it. So if I'd done that instead, I could have avoided this $12,500. One of the issues students often have with this is they want to say, well, but you did, you built the building, so nothing's avoidable. Well, no, it's avoidable because we're pretending. And that's what this diagram is supposed to show. Let's pretend. If instead of having this 3-month construction period, if instead we had paid off the bank, what would we have saved? We didn't save it, but what could we have saved? The logic here makes a lot of sense. The problem is I don't always know what that interest rate is. Because what if I'd only taken out a $100,000 loan? Well, I still had to pay you $500,000, which means I got $100,000 from my construction loan, and I got $400,000 somewhere else. I have to figure out an interest rate on that something else. And so I don't have one set interest rate. The other thing that messes this up is, what if I hadn't paid you on 9/30? What if instead I'd paid you some of it here at 6/30? What if I'd paid $250,000, and then I only paid the rest of it, the other $250,000 here at 9/30? What would that have done? Well, this equation down here isn't really set up for either of those two problems, the interest changing or different periods of time. So FASB said, you know what, we can rearrange that equation. We can rearrange it. What if instead of doing it this way, what if we say, well, take the payment that you make and multiply the payment by that period of time, so the 3/12. That would give you $125,000 of weighted capital. Instead of being now the interest that you would have avoided, this is the principal you could have avoided paying the interest on. And I could now multiply that by the 10%, and that gives me the same amount. Notice it's exactly the same. The equation works either way. But now this is set up so that I can figure this out. What if I'd done the other schedule and paid the $250 on 2 separate payments? Well, now I could take the $250 from that first payment, and let's see, June 30th to the end of the year would be 6/12, so that'd be $125. And the other $250 would still be the 3/12 because it's paid at the end of September, so that would be $62,500. If I add those up, that's what we call our weighted average expenditure. It's the same as this number, it's just with multiple payments. And now I can figure out different interest rates, I can add in different things. It gives me more flexibility. And again, the equation mathematically works out the same. We're just flip-flopping what we do first. So that instead of tracking the debt, I can track the payments that I make. And I could have 12 different payments and record 12 different weighted average expenditures. So that's FASB's logic here, is they're just rearranging this equation up here to give us more flexibility later on. And that's what we're doing. Now, let's finish up talking about these steps. So, that's our first step. We calculate those weighted average accumulated expenditures. Take the payments that you did make to the construction company or to your own employees or to buy raw materials or whatever, and multiply that by the fraction of the year that you could have avoided paying debt if you had paid the bank instead of buying that stuff or paying for it. With the diagram that we just drew, hopefully that makes sense. The second step is we're going to break down those weighted average expenditures into 2 pieces, financed and unfinanced. So let's put financed over here and unfinanced over here. And we had $187,500 in this weighted average expenditure because we made those 2 payments at 2 different times during the course of the year. One at 6/30 and one at 9/30. Now, FASB has a different definition for finance here than we normally use. Normally when you think about financed, you're thinking, did I get debt or equity, or did I pull it out of just my normal cash reserve? And that would be what we typically think of as financed and unfinanced. FASB has a slightly different definition in this scenario. Financed in this case, and only in this case, means, did you get a construction loan? And the reason that we break it up like this is because construction loans have all sorts of restrictions and rules about how you can use the money. So if you don't get the project done on time, or if you don't build the asset you said you were going to build and you do something else with it, then you're hit with all sorts of penalties and fees and legal issues, and it's a mess. Under avoidable interest, we're going to pretend you pay back the bank. You would have to pay back the construction loan first. Otherwise, you'd have all these legal and fees and all this other stuff going on. So FASB is basically saying here, you would pay off the finance portion, the construction loan first, and then if you had anything left over, you'd pay towards general debt. And that's what unfinanced means in this case. It's our general non-construction loan debt. So let's take a look at our specific example here. We took out, you remember, a $500,000 construction loan on January 1. And then I made my payments on 6/30 and 9/30. I paid out that $500,000. If I had sent those checks to the bank instead of paying you to build this building for me, I could have paid off $187,500 of this principal. Again, just during that construction period, because that's all I can count. I can't count the rest of it. And I would have nothing left to go to general debt. I wouldn't have even paid off my $500,000 loan at all. So I've got nothing left over to pay towards other debt. Now let's just take a look at a couple of other examples here. Let's say instead you had a $150,000 loan. That's what I took out on January 1st. Well, now if I had $187,500, I could pay off the $150,000 and I would still have $37,500 that I could use to pay off other debt that was out there. And that's what we're talking about in this step 2, is we're breaking it down. I would have paid off my construction loan first. Anything left over would go to unfinanced or the non-construction loan, and I would have paid that stuff off. Now, let's do one last example here. What if I didn't take out a construction loan? I just went back to general bonds. I had some cash left over from those, and I used that. Or I went to the owner and got them to give me the money. So I didn't take out a construction loan. Well, if I didn't take out a construction loan, then none of these weighted average expenditures would be financed. And they would all go to paying off my general debt. That's what this step is doing, is we're breaking it down. Again, we put as much as possible to the construction loan. If you have no construction loan, then obviously you can put 0 there. If you have weighted average expenditures above the construction loan, then you pay off the whole construction loan, and then we assume you pay the rest. And again, it's all based on FASB's assumption that if you were to pay off debt instead of constructing the asset, you would not want all the fees and penalties associated with the construction loan, so you would pay it off first. All right, let's finish up these steps. Step number 3, we get a weighted average interest rate on non-construction debt if we need to, if we've got anything over in that non-construction column. So if we have anything over here, then we would need to do step 3. If this is a 0, like in that first line, then I can skip step 3. Number 4, we multiply the financed payments by the construction loan interest. And then we multiply the unfinanced payments by step 3. So let's take a look at our diagram again. So I would multiply this by 10%, or if this were the scenario, I'd multiply this by 10%. Over here, I would multiply these by the step 3 rate. And over here, of course, here and here, it doesn't matter because they're 0, so it's going to go to 0. Anyway, you can multiply by whatever number you want to in those scenarios. So those are our steps. We're going to calculate that weighted average interest rate only if we've got something in that unfinanced column. Then we'll multiply the financed portion by the construction loan interest rate, anything in the unfinanced column by that weighted average interest rate from step 3, and finally we'll sum up all the interest on the financed and unfinanced payments. We'll bring that back together. So one last time, let's go back to my diagram. We're going to take this number, whatever it is, and this number, whatever it is, and we will add them up. And this value is my avoidable interest. A lot of concepts and ideas rolling around here now with this avoidable interest. The long and short of this is once we go through this process, we take a look at the number that comes out of this avoidable interest calculation, and we compare that to the actual interest accrued, and whichever one is smaller, we can capitalize. And that's a key idea. Knowing how much and when you can capitalize interest is a key concept to dealing with property, plant, and equipment. Next, we're going to work through this process from beginning to end with an example, and hopefully it'll make much more sense then. We'll do that in the next segment. See you then.